Let's dive right into this explainer. Today, we're unpacking Primaris REIT's Q 2026 results and looking at how they're absolutely masterfully navigating the modern retail landscape. You know, if you've been skimming financial headlines lately, you'd probably think traditional retail real estate is fighting a completely losing battle. But today, we are looking at a company that is entirely rewriting that narrative. So what happens when massive department stores actually close their doors? It's a question that really plagues the commercial real estate world, right? But Primaris, they might just have the most lucrative answer out there. For years, the whole story has been about the retail apocalypse and the death of them all. When a giant anchor tenant leaves, it's supposed to spell disaster. But what if that disaster is actually a disguised gold mine? Well, that's exactly what we're exploring today. To understand how they're doing this, we're going to follow a pretty clear roadmap. First, we'll look at the Canadian retail landscape. Then, we'll dive right into the Q2 2026 financial highlights. After that, we'll explore this massive HBC space opportunity, review their portfolio optimization strategy, and finally, wrap up with their future outlook and targets. Okay, so part one, the Canadian retail landscape and navigating the new normal. Let's take a look. So there are these huge dual pressures shaping Canadian retail right now, and they're presenting both a massive challenge and a totally unique opening. On one hand, you've got these widely publicized department store failures, and yeah, those are creating some massive, daunting vacancies. But on the flip side of that, we're seeing some serious institutional consolidation. The major players in the space are changing, the dynamics of who actually owns what are shifting, and inside that shift, there's a tremendous amount of opportunity for a highly specialized operator. Enter Primaris REIT. They're really the protagonist of this explainer, and they hold a super unique position. They are actually Canada's only real estate investment trust focused strictly on enclosed shopping centers. They aren't getting distracted by warehouses or office towers. No, they are laser-focused on retail. And as we're about to see, that focus is paying some massive dividends. Moving on to Section 2, Q2 2026 financial highlights. Let's look at the actual numbers behind this so-called fortress balance sheet. The raw numbers here really just speak for themselves. They generated a massive $174.1 million in total rental revenue, and that is just in the second quarter of 2026 alone. It's a solid increase from the same period last year, and it basically proves that their properties aren't just surviving, they're actively generating some really significant growing cash flow. And backing up that revenue is a truly formidable portfolio. Their total assets currently stand at $5.3 billion. I mean, we are talking about 14.6 million square feet of gross leasable area here. The scale is absolutely massive, and it gives them the leverage and the footprint they need to really dictate terms in the Canadian retail market. Now, this whole fortress balance sheet strategy is really underscored by an impressive 91.1% committed occupancy, plus some incredible liquidity. They have a debt-to-asset ratio sitting quite comfortably at just 40.5%. You know, in real estate, leverage can be your absolute best friend or your absolute worst enemy. Primaris has kept theirs remarkably conservative. Add in the $655.1 million in total liquidity, and you've got a company that isn't just playing defense, they literally have the financial firepower to go on the offense whenever they want. All right, Section 3, the HBC space opportunity. This is where they're flipping the whole anchors tenant problem on its head. The math behind this is just staggering. Get this, they are replacing historical $4 per square foot leases with new tenants who are expected to pay somewhere around $17 per square foot. When the Hudson's Bay Company, or HBC, disclaimed their leases, it left these giant gaping holes in Primaris properties. But those old department store leases, they were notoriously cheap. So, by redeveloping this space for modern, high-quality tenants, Primaris is effectively turning a vacancy crisis into an absolute revenue multiplier. And if you're sitting there thinking this is just some optimistic, hypothetical projection, think again. They aren't just crossing their fingers hoping to fill this space. They have already secured, or are in advanced negotiations for, a staggering 84% of it. That is over 880,000 square feet of former department store space already accounted for, with move-ins rolling out between 2027 and 2029. So what does this all mean for the bottom line? Ultimately, these new leases are expected to generate $14.9 million annually. That represents a four-fold increase, literally 4x the revenue, over what HBC was paying for that exact same space. It's a real game changer that completely shifts the economic profile of these shopping centers. As their president and COO, Patrick Sullivan, points out here, This robust leasing momentum is directly driving occupancy growth and making their centers much more productive. You have to remember, this isn't just about plugging a hole in a mall. It's about upgrading the entire ecosystem of the property. Better tenants bring in way more foot traffic, and that foot traffic ends up benefiting every single smaller retailer in the building. It's a total win-win. Moving to Section 4, Portfolio Optimization Strategy, focusing on their highly active June 2026. June 2026 alone was just an absolute whirlwind of strategic recycling for them. They were shedding non-core assets while tactically scooping up full ownership of key spots. For instance, they sold off almost $100 million in properties that just didn't fit their core vision anymore. But check out June 5th. They bought a completely vacant HBC box at Devonshire Mall for just $4.5 million. Why? Well, so they can control it, redevelop it, and apply that 4x rent multiplier we just talked about. It's incredibly smart. Now, looking at their 3-year targets, they haven't just barely met expectations. They've completely blown past their acquisition goal. They originally targeted over $1 billion in acquisitions, but they've actually achieved nearly $2 billion, $1,955 million to be exact. They're decisively consolidating their position in the market, all while disposing of assets right on target to help fund that massive growth. And as CFO Rags de Valor reminds us, absolutely none of this optimization happens without the financial flexibility of their low-leverage model. I mean, think about it. You can't buy back an empty anchor box or grab 100% interest in a prime mall if you are drowning in debt. That 40.5% debt ratio we looked at earlier, that's the engine. It's what allows Primaris to be opportunistic while all their competitors are essentially forced to pull back. Okay, final section here, number 5, future outlook and targets. Let's look at how they are positioning for growth. They're holding really steady on their 2026 guidance across the board. What really stands out to me is their disciplined projection for same properties cash net operating income, which is a huge measure of their property profitability. They expect that to grow between 1.0 and 3.0%. They've also targeted a redevelopment capex of $60 to $64 million. Interestingly, about $35 million of that is specifically directed at preparing those vacant HBC anchor spaces for the new, high-paying tenants. It takes money to make money, right? And they are deploying it very strategically. But their growth engine definitely doesn't stop there. They still have some massive levers left to pull. Think about it. Malls traditionally sit on massive, sprawling parking lots. Primaris has actually identified roughly 120 acres of excess land that they can potentially monetize, which they value up to $375 million. Combine that with another $200 million in non-core properties ready to be sold, and you're looking at over $500 million of embedded value just sitting there, waiting to be unlocked and reinvested. CEO Alex Avery perfectly sums up the outcome of this whole calculated strategy, delivering above-average earnings growth in what is admittedly a challenging sector. It's a huge testament to the fact that retail simply isn't dead. It just requires a much smarter, way more proactive landlord to actually thrive. They aren't just sitting back collecting rent checks anymore. They are actively engineering the value of their real estate. So it really leaves you wondering, in an era completely dominated by e-commerce doom and gloom headlines, what other hidden opportunities are just sitting right inside our local malls? Primaris took what the entire market saw as a liability, an empty department store, and flipped it into a 4x revenue multiplier. Thank you so much for joining me for this explainer. Keep your eyes on the data, and I'll catch you next time.